Okay, hello again, everyone. This is part two of Managerial Accounting, Chapter 2. And this one's going to be a lot shorter than the first part, but I just wanted to get a couple items in on the second one because they are very important in the due course of business. So, what do the terms overapplied and underapplied overhead mean? Well, just like anything else, overapplied means we added too much money to overhead to the overhead account, and we ended up spending a lot less. And underapplied means we added too little amount. The amount wasn't enough, and we there was a shortage, so we are going to have to pay more money. So I'd rather it be overapplied than underapplied, but sometimes it just depends about the amount. So let me explain a little further. So underapplied overhead, as shown in the manufacturing overhead account, at the end of the reporting period, actual overhead costs are higher than overhead costs applied to jobs, meaning that we said it was going to be $300,000 for overhead, but it ended up being $400,000. Not good for our budget, not good for our plan. We're $100,000 out of whack. Overapplied overhead, as shown in the manufacturing overhead account at the end of the reporting period. Actual overhead costs are lower than overhead costs applied to jobs. So we have a surplus, which is good because we say, hey, we've got a little bit of extra money and it'll help us because maybe we were a little bit off on other portions of our budget. So how is the manufacturing overhead account closed at the end of the period? So companies typically close the manufacturing overhead account to cost of goods sold at the end of the period if the amount is not significant. If overhead is underapplied by $2,000, the journal entry to close the account looks like this. $2,000 manufacturing overhead goes to $2,000 in cost of goods sold. Why does it go there? Because it actually should have been applied to cost of goods sold. It's just our estimate was no good. Now, if it overhead is over applied by $3,000, the journal entry to close the account shows that $3,000 in cost of goods sold goes back to manufacturing overhead, which means that now we're okay, and we have an extra $3,000. So $3,000 that was in cost of goods sold goes over to manufacturing overhead. So apply job costing methods to service organizations. I work for a service organization, but like I said, for managerial accounting, it's best to utilize manufacturing organizations to kind of show you the step by step. But it also applies to service organizations. So how does job costing work in a service company setting? Same as manufacturing, except service companies use fewer materials and the account names are slightly different. That's all. So let's look at table 2.2, manufacturing organization count name, raw materials, service organization account name, parts, inventory, or supplies. Like say if you were at somewhere doing oil change for your car. Uh, Work in process, inventory, work in process, same thing for service. Finished goods inventory, don't have finished goods in a service organization. Cost of goods sold in manufacturing, cost of services or expense account would be how it would be labeled in service organization. And manufacturing overhead for manufacturing organization, and overhead for a service organization. So pretty similar still. So use a job costing system to track costs and evaluate profitability for each job, or if, for instance, in a service company for each service department. So how is job costing used to perform job profitability analysis at a custom furniture company? It looks like this. And so this is the last slide, but what I want you guys to do is go and look at the PowerPoint or look in the book and check this out because this is real world managerial accounting activity. So you see the estimate, right? What's our sales price? What's our actual? Direct materials, estimate 1,500. We actually spent 3,500. Direct labor, we thought it was 3,300. We actually spent 3,800. We see we're going in the wrong direction right here in job 40. Manufacturing overhead 6,000 estimate. We actually spent 6,200. Total production cost, we spent well over $2,000 for our total production. Gross profit, we ended up our estimate was that we would make 7,560. We ended up making $4,860. Somebody's off. Somebody's going to get in trouble because their forecast and their estimate was not accurate. So gross profit as a percent of total production cost, 70% was our estimate, but we actually only made 36%. And you can look at that in job 44 and job 45 as well. So as always, have a good day. Have a great week. Make sure that you Watch the lecture, watch the other supplemental videos that I put there because they're quite interesting. I want you to ensure that you take your quiz and do your 2 assignments. And for those of you that I see in class, I'll see you guys on Tuesday. Those of you that I see online, I'm seeing you right now. So as I said, have a good day and a great week.